Good morning, everybody. It's Tuesday, September 10th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here, December corn down 1.5 pennies at 405 3/4. November soybeans were down 12.5 at 1005.5, and December Chicago wheat was up 3 1/4 at 571 3/4. Yesterday afternoon, we had crop progress conditions out. Corn dropped 1 percentage point in the good to excellent category at 64%. Soybeans held steady at 65%. Corn harvest came back 5% complete. That's versus 4% last year. Winter wheat plantings, 6% completed versus 2% last week and 5% last year. And spring wheat harvest continues to really move at a rapid pace at 85% completed. That's against 70% last week and 83% last year. Good morning, guys. Hope everybody's doing well. We did see some deliveries overnight. We were talking about this a little before the show. There were 32 bean deliveries, 90 meal, 119 corn, and 5 Kansas City wheat. Dustin, maybe just a few thoughts. I know you were looking at the spreads here this morning. Just a few thoughts to kick us around, get us started, and we'll kick it around the room.
Yeah, so I think we're looking at low river levels at the moment, and we've got this. We're still kind of getting used to this 8 cents a month storage rate that changed a while ago, back in December of 2019. But we're just finally getting back to an actual carry in the corn market where this applies, and low river levels certainly impact that. Basically, giving up ownership of those receipts. Right now, even we traded down to 25 under last night on the SEP to December. That would be about a 5% interest rate. So I would consider that full carry myself. That's the risk-free rate right now. So, we're going into rate cuts as well. It's, to make a 5% interest rate over the next 3 months, this is an annual interest rate, and have control of those receipts in a higher demand market. It's just kind of a sign of the times. This happened last year, and then we had, it took all the way till November until the December contract did the same thing, right? When December started falling against March. But I think, if anything, this is a precursor of what's to come. If we're that full, if we're seeing cash carries, first half SEP to second half SEP in many of these locations, we're that full coming into it. And then we're talking about a record yield in both Iowa and Illinois. There's a good chance that the market is going to see another bout of weakness in the spreads, D's to March, D's to May, and there on out. It's just, we would be swimming with supply if the current projections for yield, in my opinion, manifest themselves and we go right into the next first notice day.
Yeah, we got some estimates. We'll have that report on Thursday. I don't think anybody's looking for major fireworks, but it is a USDA report, so you always got to be careful. Interesting. The low end of the ranges, for corn and bean yields are 180.5 on the corn side. That'd be like 2.5 bushels or so lower than August. 52 would be a bushel, a little over a bushel lower. And we were talking before the show, Justin, you thought, to get these overly record type yields, you got to finish good. You've said it a number of times. And I mean, anecdotally, we're starting to hear of solid yields, but nothing that's like, takes you to that next upper echelon of records. So maybe a few thoughts there.
Yeah, we're early, obviously. So we're just getting into stuff. And, you just look at, we had a dry finish. I think no matter how you look at it, especially Indiana, Ohio, western half of Iowa, quite a bit of areas, except for probably the north, west third of Illinois into eastern Iowa. But it was just a dry finish. Luckily, we were cooler for a lot of that, so I think that helps them. But it's one of those things we'll see in the end, and I think we're going to see some gigantic crops still in a lot of these areas. It's just, how much did you lose? And we talked about this months ago, where I would call this the third year in Illinois where you had kind of record potential and even record yields in the end for some people, but maybe they took 20, 30 bushel off at the end. Where crop just kind of ended quicker. It didn't have as long of a grain fill period. All those things matter to get that very top end of yields. So again, it's early. We've heard some good yields, kind of 250 to 270 type stuff in Illinois. So by all means, really, really good. We're not hearing the bin buster type 300 type stuff yet, but it's early. Beans I'll be really interested in. We've heard, early bean yields in Illinois are, maybe 5-10 bushels below a record, which is obviously a bigger percentage when you look at beans versus corn. Again, we got to see how we finish. I personally don't think the dry finish we had is conducive to the record bean yields. And we talked about this before, but when we had that massive shift from continuous corn on corn on corn to a 50-50 rotation across the heart of the belt, that's where we saw those 100 bushel bean yields on, big plots of land, and had, basically zero disease pressure. It was kind of a perfect conditions, and we rained throughout the entire season. So I think to get a pro farmer type number is going to be a real challenge, in my opinion. The problem at the bean balance sheet is that there's 200 plus bushels of demand that are, I'll call fluff, that the USDA's put in there because we do have potentially big crops. So there's definitely a buffer there in beans, and that's kind of the challenging part. If we had a moderate demand number written down and we had this kind of weather, I think beans would be acting stronger than they are. I think we're not seeing enough demand, enough things to say that, hey, the USDA's demand number is accurate. China's got their own GDP problems. They're slowing down, a slowing economy, obviously the biggest buyer of beans. So we've got a demand question mark. And I think that's, we haven't seen enough of a supply scare or even really evidence yet to show that the government's wrong. So until those things happen, I think we're kind of stuck here a little bit. But from a supply standpoint, I think the big numbers that people were writing down, 2, 3, 4 weeks ago, I think would probably be towards the higher end of what we could see.
Yeah. Ben, what's your thoughts this morning?
I think it's interesting to see where this ends up as we finish. Back in May and early June, we were talking about, what does a few bushels difference mean to the balance sheet? And when I look at corn, they made some pretty good adjustments just to keep it above 2 billion bushels the last time with a 183 yield. If we can still have a great crop at, whether it's 178, 179, but I think that does start to have a little bit more supportive implications if we're not going to blow this thing up huge on yields. But my bigger concern is we went the previous year, we have this incredibly May and June dry time frame. We get timely rains, we have a really good crop. I think we saw that translated this year into managed money, not really wanting to cover all their corn, never really taking a crack at getting long, heading into our critical growing stages. Now you take some dryness and granted not a lot of heat in the August timeframe for soybeans, and I think kind of a muted response for the amount of dryness that we've had. And to Justin's point, it could be from the big buffer of exports. But at what point do you ever make the speculators want to be long and want to get long grains if we're slowly dispelling, age-old wisdom of what can hurt our crops? So, and I think that will make, whenever it happens, and it will happen again, whenever that turn ever comes, I think it could be very violent. So I just, I don't like to see extremely muted reactions to what we would perceive as historically negative inputs for grain production. And I think we could be building a case for that here in a different way in 24, just like we did in 23.
Well, Ben, we talked about this a while ago, but, it could be the realization that the South American crops are bigger than ours now.
Yep.
And so there's more onus put on South American growing season. We've seen that it's changed seasonalities, it's changed behavior. I think the early estimates are for another expansion in Brazilian soybeans, both in a recovery in yield. So, 15, 20 million more tons than this year even. Again, that has to be grown. you hear a lot of stuff about how dry it's been. The problem is the dry season, like an average month is like, we looked this up, like an inch of rain. So when you say you're 20% of normal, you're at 0.2 versus an inch. So the dry season is very dry. Now, if that were to carry into, when the monsoon season, when the rainy season starts, I think that's when funds get pretty nervous, because it's such a big chunk of global production now, that we might be, if we prove that we have a good yield, which we're going to have a good yield, it's just trying to fine tune what that means. I think you probably have to have a real South America scare to get, to your point, Ben, of the funds that want to be long commodities, grains, again, some kind of a real scare.
Yep.
Well, it's like Dustin kind of alluded to it also just in his comments is, if you get into, this, call it a rate cut environment, or that we're now starting to ease on rates and things like that, what is that going to do, or also have an effect on sort of what we've seen from money flow, right? Stocks to commodities and in that trade.
Yeah, it's tough. I mean, I think a lot of people were happy with 5% interest rates. We hadn't seen it in a long time. So people that have cash, right, to earn 5% interest has been, I think pretty nice. You start, as you cut rates, you change that balance of what people think an acceptable return is, right? So you naturally get a shift, in my opinion, right? You're going to get a shift into certain things that can yield higher than 3% or whatever that interest rate goes down to. So yeah, that could definitely be helpful for commodities. Right now, it's still been commodities and crude oil, crude oil especially has been pretty weak. I think a lot of that's, China, the elections coming up, just uncertainty in general with where policy is going to go. But, after the election season, I think things could turn a little bit.
Yeah, I think, just staying power for individuals holding, let's just say, think about an operating note, like holding grain in the bin. I think everyone last year and the year before started to, etch out that number. They're basically carrying it around in their pocket. Like, this is how much money it costs me to hold this grain in the bin unpriced, right? It's X amount per month, per day. And, so right now, like, for example, risk-free rate, plus like a 2% credit spread, you're just over 2 cents a month on holding corn, which can add up pretty quickly, where we get out to, July and August, we really have to see a pretty good cash carry to justify holding it that long. And cash flow is already tight as it is. So when I look at, like, if you go from a 5% risk-free rate back down to 0, that's a pretty big difference. That's about, if we target 60% of full carry on a per year basis, that's about 10 cents of a narrower spread, just because it's going to be a lot harder to, jar those bushels out of the bin. I think it's easier staying power, when capital is not worth as much. So it can definitely have an opinion, or, like, just a factor for how fast grain moves. I actually think that in this environment, when rates are still quite high on the individual operating note, you might force a lot more selling faster in a year like this, just because everyone needs to pay down debt, needs to stop that interest. And it could be a little bit faster than we saw last year, in my opinion, because we had such high cash flows coming into it. So that's the one thing I'm kind of just a little bit nervous about this harvest, is the need to raise cash is probably a bit higher than it was last harvest.
That's a good point.
Yeah, and the problem is if you go back to a risk-free rate of 0, we probably got bigger issues. Then we could be looking at just a down economy.
Right.
Yes.
Right? So you'd hope that we could find some interest rate here that we stabilize at, 3% or something that's kind of comfortable for both sides of the equation.
Yeah, the world is we've gotten used to this zero interest rate policy for over a decade, which is absolutely pretty insane when you look back at, like, any other decade. And so we've gone way too low for way too long, and we had to counter that. And even today's risk-free rate is not like that far out of line for history. So
right.
3 to 4%, is that our new normal? I mean, we have deficits that we have to consider too. I mean, like, we're, our debt to GDP and the cost of interest, there's a good chance that like we just continue to have to kind of, in a way, like keep printing money and keep monetizing this. Maybe hard assets are going to continue to float higher, and that's a much harder thing to fix. That's why I don't want to, like, people ask me about hedging D's 26 corn. I'm like, I don't see a good reason to go that far out at all, in my opinion, because like, how do you know what your cost of production is going to be? How do you have any insight to what things are going to cost in dollar terms out that far?
Yep.
And potential changing in products, like insurance products and things of that nature. Things are evolving so rapidly that to make some of those decisions could handcuff you.
Right. I hear this all the time. Like, oh, $5 is a really good price. People can make money at $5. University data shows that that's not the case. Really, like that's a losing price at average yields this year for the app. Look at Purdue, look at Farm Doc. $5 corn is not a no-brainer anymore. And I think there's a reason for that. Just like our grocery bills have all jumped so much in the last 4 or 5 years. It's a symptom of an increasing monetary supply. M2 is just shot through the roof since COVID. So I just, again, I know here now we've got a lot of extra supply and we're feeling that pinch right now with lower prices. I just don't want to look out to the next couple of years and be like, well, let's just go make the same assumptions. The next 2 years are going to be the same. We got to be kind of open-minded, I think.
Well, yeah, a lot of times to do that, to justify it, you have to write down a record yield in your head and just say, well, I can sell this price if I grow a record. It'd be great if you knew that.
Mm-hmm.
But I think it's just kind of we talked about this too. It's just like what recency bias, right? You're looking at like, well, September corn just got to 360, so if I can sell 460 for 2 years out forward, like that's a good price. But nobody liked $5 corn when the nearby was 6.
Yeah, we have downturns. I mean, like we should expect some pain for a little while. I mean, we got overdone. And right now we're looking at maybe 1-2 years of pain. It could be 3 years of pain. I don't want to try to predict that. I'm just thinking, I look at that monetary supply and that interest rate. It's like there's a reason they have to start dropping interest rates. Is things are breaking right now in the economy. Things are breaking at a 5% interest rate, which is, if you were to go back 40, 50 years and say, hey, we can't survive on a 5% benchmark rate, those people would think we're nuts, right? We've gotten so accustomed to zero interest rate policy. So I'd be very curious to see what hard assets are 10, 15, 20 years from now. I think we could be surprised with how much we've lost on purchasing power.
Very good. Well, quickly here, Ryland, yesterday cattle held the lows and we had a pretty nice pop throughout the session. And we're also starting to see hog weights jump. So maybe just a few thoughts as we come into the morning here.
Yeah, so we had a little reversal. I mean, I don't know if you want to call it a technical reversal, but we definitely held those August lows. So I think there's a little bit more optimism. I mean, right now we got the roll going on, so it looked like open interest was down, over 2,000 contracts. So it seemed like there was a lot more interest in kind of selling the front end and rolling out a little bit further into the December, especially for next year's prices. So I think there's going to be a lot of eyes on cash this week, just considering last week's 181 versus the board at 176. So you still got this big discount, and I'd expect the volatility to kind of stand this week, especially when we know that the managed money is probably moving their positions out forward. So still no cash, but I think at this rate, the market wants to see steady. The board's saying lower, but we'll see if that starts to narrow up sometime this week. Hog market, yeah, weights are coming up. It seems like we got, overall, it seems like we're not really that current at this point. And the market's been on this big rally, but we've had 4 days straight down. And the action was a little mixed yesterday, but looked like some of that commitment was coming down out of the front end, just like in the cattle market. So it still seems like the big roll right now is looking more towards going from Oct to December. So it just feels like we got plenty of hogs around, but the managed money has really been aggressively buying this thing, and it feels like they're just a day late and a dollar short when it comes to some of the big moves here. They've been the big support in the market, while cutout and cash have been kind of drifting lower. So it just feels like they're on the wrong side again. We could see another round of liquidation. So just good to probably stay hedged, especially for a December timeframe. It just feels like you could see much lower prices if we see just a glut of hogs in this next quarter.
Very good. I appreciate the update. Just came into the open here. We got December corn down 2 at 405 1/4. November soybeans down 15 3/4 right now, 10.02 1/4. And December Chicago wheat's up 4 3/4 at 573 1/4. We appreciate everybody on a daily basis that tunes into the show. If you enjoy it as much as we like putting it on, throw us a like or subscribe. Certainly helps us out, and it'll keep you up to speed on everything AgYield, give you all that custom premium content. So like I said, doesn't cost anything. Throw us a like or subscribe. We certainly appreciate that. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments, guys. It was a good conversation this morning. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.